One thing that's kind of counterintuitive, when you have deflation, which means, okay, prices are coming down, that's all it is. So if you're used to hearing about inflation of 2%, 3%, 4%, inflation is when prices are negative 2%, negative 3%, negative 4%. Those prices are dropping. So how do we calculate real interest rates? Well, we take the nominal interest rate and subtract inflation. So right now, I'll use the 10-year Treasury note. You can pick a lot of different rates and a lot of different inflation gauges. You have to specify, but I'll use the yield to maturity on a 10-year Treasury note and CPI. So the yield to maturity on a 10-year Treasury note is 3.5%. And CPI, round numbers, is about 7.5%. So what are real interest rates? Well, you have to take 3.5 minus 7.5, and you get to negative 4. So real interest rates are actually negative. They're, as I say, negative 4%. So that's highly stimulative, by the way. So it's why the Fed thinks they got to keep raising rates. But now let's do the same math in a world of deflation. So let's say that interest rates are 2.5%. So yield to maturity in a 10-year note is 2.5%. But deflation is negative 2, meaning deflation is 2, so inflation is negative 2. That is what deflation is. So now when you do the math, in that example, you get 2.5 minus negative 2. But when you subtract the negative, it's plus. You add the absolute value. So in that example, it'd be 2.5 minus negative 2 equals 4.5. In that world, the real interest rate is 4.5%. That's high. That's a huge real interest rate. I mean, I remember my first mortgage was 13%. And my mother cried. She's like, because her first mortgage was like 2.5%. I said, yeah, but Mom, it's 13%, but inflation at the time was 15%. So I said, my real rate's negative 2. And by the way, it's all tax deductible, and it was a 50% bracket at the time. So it was really negative 8. I mean, I was stealing money because of the impact of taxes and inflation. So the 13% nominal rate was actually negative 2 because of 15% inflation. But here you have a situation where the nominal rate is way down to 2.5%, but the real rate is 4.5% if you have 2% deflation. So deflation is a killer because it raises real rates even as nominal prices are going down. So again, that's the kind of through the looking glass mentality when you have to, it's not complicated, but subtracting negatives is piling on, it's adding to the real rate. And that slows down growth even more, and that kind of deflation feeds on itself. And of course, that's exactly what we saw during the Great Depression. Now, there's another problem. It's even scarier, and this is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, etc., and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful, there are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion. They do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. So the problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. And however, a quick footnote, we did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration, then Franklin Roosevelt came in 1933. And Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine the President of the United States today, I don't care if it's Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did to break the banking panic. But he still had the deflation problem. And the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? He said, yeah, that's it. You understand it correctly. But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75% from $20 an ounce to $35 an ounce. And that worked because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand, so it was like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, oil, get the price of everything else up. And it worked. In the middle of the Great Depression, from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level. It was still depressed, but it did much better. The Democratic theme song was "Happy Days Are Here Again." Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression. That's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Inflation is very troubling, and should be, to central bankers, economists, and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself. There's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So it's one reason to have gold. Everything I'm describing, we've been focusing on the U.S., but the U.S. is the world's largest economy, and the dollar is the world's largest payment currency and reserve currency, et cetera. So it's a good place to start. But we're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession, or Japan, or the U.S. Usually there's another economy or economic group that's doing okay, or at least better, and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening. And that's what we had in 2008. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries, I mentioned Switzerland, India, China, Japan have all seen their U.S. dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the U.S. dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, well, it's 18.